Well, I'm with Ian Bailey, the leader of SmartPay, partway through a roadshow he's been holding in New Zealand, talking to brokers and shareholders about where the company's at. Ian, I guess the fundamental question is, what does SmartPay do?
We're in what we call the merchant services market, and that means we provide a whole range of products and services to merchants on a subscription basis. So those services include telecommunication services such as Wi-Fi, voice over IP, payment services, EFTPOS terminals is the most obvious one in that, and also marketing media services. So within a store you can run audio systems or digital signage. We provide all those services wherever possible at a broadband connection, and provide that on a subscription or monthly revenue fee, and we manage the customer base directly ourselves.
Right. Now, the company is in a market segment that is new to the marketplace. It's probably seen as a technology company, but you describe it as a merchant services business. Is this a high growth segment?
Yes, it is. The standard product range that everyone will recognise immediately, of course, is EFTPOS terminals. But we do not sell EFTPOS terminals. We provide them on a subscription basis. So wherever possible, we also provide other services located on those terminals, whether they're loyalty programs or gift cards, or the ability for merchant to make money from those terminals by the provision of merchant services such as mobile phone top-up.
Now, who then are the competitors? Do you have this market segment to yourself?
Well, there's competitors in every segment of our market. So there's competitors who sell EFTPOS terminals, there's competitors who sell telecommunication services. The significant difference between us and everyone else in the market is that we own, manage and support our own intellectual property and software. So what that means is we can bring a product in from overseas. We can load our own software into it. We have a differentiator to everyone else in the market. We market it directly to our customer base through our own sales force. We finance, service and support it. And in that regard, we're the only company who does that.
Now, the market is dominated partly then by the banks. Are they in this market segment?
Not really. The banks, we work very closely with all the banks in New Zealand. The only one who has their own distribution sales force is ANZ Bank, through their company called EFTPOS New Zealand. But everyone else runs directly through third-party agents, dealers and support. So we have our own sales team of over 50 people who go around every day making sales into the marketplace.
And the customer base? I notice there's been quite a few statements about the new customers being taken on by the company. What type of customer are they?
Well, look, it ranges from the small SME customer to a corporate to the mum and pop dairy owner. So we have quite a wide range of products fit into each one of those sectors, and we've been very successful in the corporate sector. We've picked up over $11 million worth of forward orders for installation by March of this year, and our existing customer base, we were rolling that over with new product and installing new services, is going very well as well.
It's just over a year since you expanded the company by way of acquisition. What's the difference between the business that you took over and the business that you run today?
We were really primarily interested in purchasing the customer base from the Provenco Cabinets business. That went into receivership, and that company was focused heavily on the sale of individual hardware products. So that was in New Zealand and overseas. Our business is not in the provision of hardware products as such. We sign customers up for a long-term contract, 3 or 4 year contract with regular, known, committed cash flows. So think in terms of Sky television model as opposed to an IBM sales model. That's a subtle difference.
And where are you with the business today? Has it been a busy year for you?
It's been an exceedingly busy year for us. We effectively swallowed an elephant. We've done that. It's done it successfully. We now have huge opportunities presenting themselves in both the New Zealand and Australian marketplaces. We're only focused in those two markets. We've got huge amounts of opportunity to grow in both those markets now, and our organisational infrastructure is in place and ready to handle it. So yes, we've been very, very busy integrating that acquisition.
And the earnings position, you've had one part period with the expanded business, the business that grew the business by about 5-fold to the middle of this year. What was the result for that period, and where are you on your projected trend line for next year?
Well, if we go back 2 or 3 years ago, SmartPay itself was actually losing money, was cash flow negative. We restructured the business about 2 years ago, and the value of that was seen in the September result, half-year result. We've made a $1.5 million operating profit, EBITDA. The end of year for March 2010 was positive 2.1 million, and this year we're forecasting 7 million EBITDA. And we focus on the EBITDA as the depreciation allowances of our products, of our terminals, are really taken up in the first 3 years, so it skews the result quite dramatically. And we can get up to 3 terms or 9 years out of that hardware product before it becomes obsolete. So in our case, the upfront depreciation being taken up to 3 years fundamentally screws the result, and that's why we focus on EBITDA as our financial targets.
Thanks, Ian.